Did you know that the US can indirectly export inflation to the rest of the world? It's an intriguing concept, isn't it? So let's dive right into it. Exported inflation is a phenomenon that happens when one country's economic maneuvers impact inflation rates in another country. While the United States does not have direct control over inflation in other nations, its monetary policies and trade dynamics can certainly cause ripples across the global economy. For instance, when the US Federal Reserve increases the money supply or decreases interest rates, it can lead to depreciation of the US dollar, making American goods more attractive to foreign buyers, thus creating inflationary pressures in other countries. Similarly, changes in US demand for commodities, fluctuations in global financial markets, and persistent trade deficits can all contribute to this exported inflation. But how does this exported inflation manifest in real-world scenarios? Consider the impact of currency exchange rates. Imagine the Federal Reserve decides to increase the money supply, perhaps by printing more currency or lowering interest rates. This move can lead to a depreciation of the US dollar relative to other currencies. Now, when the dollar weakens, a fascinating chain of events begins to unfold. US exports become cheaper for foreign buyers, and this affordability leads to increased demand for American goods and services. Consequently, countries that import a significant amount of goods from the States may start to feel the heat of inflationary pressures. The mix of high demand and low cost can stir up the inflation cauldron in these countries. But remember, it's not just about the currency exchange rates. They're a significant cog in the wheel, but there are other gears at play in this complex machine of global economics. Yet, exchange rates are just one piece of the puzzle. Now let's shift our focus to commodity prices. The United States is the world's largest consumer of commodities like oil, metals, and agricultural products. Any change in US demand can significantly impact global prices. Imagine this. When the US economy experiences inflationary pressures, it leads to increased demand for these commodities. This heightened demand, driven by the inflation-fueled buying spree, pushes up their prices on the global market. Now, these higher commodity prices can contribute to inflation in countries that heavily rely on imported goods and raw materials. Why? Because these countries have to shell out more for the same amount of import, leading to an overall increase in their price levels. It's like a domino effect, where the inflation in one country can trigger inflation in another through the global commodity market. But the ripple effects of US monetary policy don't stop at commodity prices. Consider the global reach of the United States in financial markets. As a major player, changes in US monetary policy can send ripples across asset prices worldwide. Picture this. The Federal Reserve, in an attempt to stimulate the economy, engages in quantitative easing or similar expansionary measures. The result? A flood of liquidity in global financial markets. Now this excess liquidity doesn't stay put. It flows much like water, seeking the path of least resistance. Often it ends up in emerging markets, driving up asset prices. And what happens when asset prices inflate? You've got it, inflation. This is not just a rise in the cost of goods and services, but also a decrease in the purchasing power of money. It's a complex game of dominoes, where one action triggers a series of reactions, often with far-reaching implications. And there is one more factor that plays into this complex dynamic. Finally, we come to the role of trade imbalances. Picture this. The United States is importing more goods and services than it exports, a situation known as a trade deficit. Now, when the US imports more than it exports, it's essentially exporting dollars to pay for those imports. This can lead to an excess of dollars in the foreign exchange markets. Now, why does this matter? Well, an oversupply of dollars can put downward pressure on foreign currencies. This, in turn, can potentially contribute to inflation in countries that rely on imports from the United States. The simple act of buying and selling goods on an international scale can, therefore, have a ripple effect, influencing the economic stability of nations far and wide. So, as you can see, the US's economic decisions can indeed have far-reaching impacts, even indirectly exporting inflation to other parts of the world.